Hey, this is Jussi. I run a small investment firm that specializes in REIT investing. I've now been in this space for over 10 years, and as you can imagine, I've made a lot of costly mistakes along the way. And some of these mistakes could have been avoided had I taken more time to educate myself about the dangers and the risk to REIT investing. And in today's video, I want to give you the chance to learn from my costly mistakes so that you don't have to learn the hard way. Here are 5 important things that I wish I knew before I got started. So the first lesson is that nothing matters more than the management when investing in REITs. Early on, I made the mistake of investing in some externally managed REITs that seemed to be trading at exceptionally low valuations and very high dividend yields, often in excess of 10%. A good example that comes to my mind is called Global Net Lease, ticker symbol GNL. I lost some money on that one. I understood that the external management structure could be a source of conflicts of interest and lead to higher management cost compared to internally managed REITs. However, I thought that this was more than priced in to the stock of the REIT. I thought that because it was trading at a 2 times or even 3 times lower valuation than its close peers like Agri Realty and Realty Income, that this lower valuation would more than make up for the disadvantage in its management structure. But I was wrong, and I realized this pretty quickly because yes, you were getting paid a high dividend yield, but the valuation was low. But the problem was that the management kept selling more shares to the market to acquire additional properties, which would grow the size of the REIT and also justify higher fees for the management. But because their cost of capital was so high, they were selling shares to buy properties, often at a negative spread relative to their cost of capital. So it was dilutive to shareholders. So yes, the valuation was very low, but they kept diluting you, destroying value on a per share basis. And so they were essentially digging themselves in a deeper hole gradually. So you were getting a 10% dividend yield, but let's say the cash flow on a per share basis then dropped by 5%. So in the end, you were left with a 5% annual return if you assume that the multiple remained constant. And that's really been the key issue with a lot of these externally managed REITs. The management is incentivized to keep growing the pie as large as possible, which would then justify higher fees for themselves. And so they end up raising a lot of equity to make property acquisitions that may not be accretive on a per share basis. And so a very low valuation does not help you if the management is then going to destroy value on a per share basis, just like they did in this case, in my opinion. And so, yeah, the main lesson here is that no valuation is low enough if the management is going to do something stupid that goes against the interests of the shareholders. And therefore, the number one thing that you should always do when investing in REITs is to review the management, make sure that they're well aligned with shareholders. And this is why at High Yield Landlord, which is my REIT newsletter, we very often publish CEO interviews, because it's very important for us to understand their motivations. We try to ask them the hard questions. We try to see what's their compensation structure, how much skin they really have in the game. What's their track record? These are super important things to consider, and that's the number one thing that I want to discuss in this video. Hey, before I go into the next lesson, can you please do me a huge favor and click the like button? That will help me a lot to keep on growing. Thanks so much in advance. So the second lesson is that the dividend is really just a capital allocation decision. A lot of investors will come to the REIT sector because of the high dividend yields, and they might think that a higher dividend yield may lead to higher total returns. But in reality, it has quite often been the opposite. More often than not, the lowest yielding REITs have actually outperformed the highest yielding REITs. And so this really shows you that the dividend is really just a capital allocation decision. It says nothing about the actual fundamental performance of the REIT or even its valuation. The yield may be high simply because the REIT has a very high dividend payout ratio, or it uses a lot of leverage, or it owns risky high cap rate properties that are experiencing declining cash flow. A lot of office REITs will probably fit in this category today. And then on the flip side, a REIT may have a very low dividend yield because it simply decides to retain most of its cash flow. There's this common misconception that REITs must pay out 90% of their cash flow to investors in the form of dividend, but this actually isn't correct. They must pay 90% of their taxable income, not their cash flow. And taxable income is often very low for REITs because of non-cash depreciation, which artificially reduces the taxable income relative to the cash flow. And so there are a lot of REITs that actually pay out just around 30% or 50% of their cash flow in the form of dividend. A good example that comes to my mind is SBA Communications, ticker symbol SBAC. It's a cell tower REIT in which we recently invested at High Yield Landlord. It has a payout ratio just around 30%, and so naturally its dividend yield is also very low at just around 2%, but this other 70% of the cash flow then gets reinvested in other things like buybacks today because their share price is heavily discounted, but also deleveraging, which is great today because it allows them to deleverage organically without having to raise more equity. They're also making new investments, again, making them more independent from the capital markets. They don't have to raise more equity. So having a low payout ratio is typically very positive for REIT. Despite it leading to a lower yield, it often leads to higher total returns over time. And to demonstrate this, let me put on the screen the performance of SBA Communications since it went public. You'll see there that has been one of the most rewarding, not just REITs, but stocks of the entire market ever since it went public. And that's despite consistently only paying a very low dividend yield. And now let me put on the screen the historic performance of a very high-yielding REIT, which we mentioned earlier, Global Net Lease. It has consistently been offering a very high yield of around 8 to 12% during most times. And yet its total returns have been horrible because they kept paying too much, they took on too much leverage, they invested in risky assets, and so they suffered some losses, and they've had to cut their dividend quite a few times. Their market sentiment has suffered, and they've kept making poor decisions like raising equity at the wrong time. But this really illustrates really well that a higher dividend yield does not mean that you're going to get higher total returns. On the contrary, historically, the lowest yielding REITs have most times been more rewarding than the higher yielding REITs. And therefore, the lesson here is that the dividend yield should really just be an afterthought. REITs are not just income investments. These are total return vehicles. And a REIT can very well manufacture the high dividend yield simply by paying too much or using a lot of leverage. Instead, you should really focus on the fundamentals, the valuation of the REIT, and the dividend then comes at the last point of consideration. A third important lesson for you is that lower leverage actually equals higher total returns in many cases with REITs, and this may seem counterintuitive because we always think that if you use more leverage, it will take more risk, you will likely be compensated with higher returns over time, but this actually hasn't been the case. History has shown that the more conservatively financed REITs typically tend to generate higher total returns over a full cycle than the aggressively financed REITs because of two key reasons. The first one is that they avoid disastrous scenarios of them having to raise equity at highly dilutive prices following a market crash because they are over leveraged and need this equity to remain solvent, and simply avoiding these disastrous scenarios greatly helps the average performance of conservatively financed REITs because yes, some aggressively financed REITs may survive the down cycle and do fine, but once you include the performance of those that are in deep distress, the average performance comes down very significantly. They don't suffer nearly as much pain during the down cycles. And then the second reason why the conservatively financed REITs tend to outperform over a full cycle is because they can then also take full advantage of this down cycle to buy properties done from distressed landlords at very low valuations, and buying these properties at low valuations then lead to significant gains in the recovery, and that explains why lower leverage leads to higher returns over the long run. And then the fourth lesson is that Capex is often greatly underappreciated by REIT investors. Real estate needs to be maintained to remain desirable over the long run, and that's what we call Capex. It's the cost to keep your property in good shape, to keep it leased and keep generating rental income. Most investors will often ignore the impact of Capex simply because they will rely on the FFO that REITs are reporting. FFO stands for funds from operation. It's a metric that's commonly used in the REIT sector to get a rough estimate of the cash flow, but what a lot of investors don't know is that FFO does not consider Capex at all, so often it will actually overstate the true cash flow since Capex still need to be deducted, and once you deduct it, then you get to AFFO, which means adjusted funds from operation. And so that's really what you should focus on when investing in REITs rather than FFO. Moreover, you should also remember that Capex can greatly vary over time depending on the age of the property, the market conditions, the length of the lease as well. At the moment, a lot of REIT investors are buying office REITs thinking that they have been oversold. that they will strongly recover as people gradually return to the office. But I think what they seem to forget here is that a lot of office REITs have been performing relatively well now in recent years, simply because they still had years left on their leases. But as those leases gradually expire in the coming years, I think that they will face a lot of Capex. They will have to very significantly reinvest in their properties to keep them desirable, to retain their tenants, because the office vacancy rate today is at a historic high of about 20%. So their tenants have a lot of options out there to move to other buildings, potentially with lower rents. And so if the landlords want to retain their tenants, they're going to have to offer them very significant tenant improvements. And this is going to lead to a surge in Capex expense, I think, in the coming years. And once you take this into account, office rates actually aren't this cheap. I learned this lesson with mall REITs leading up to the pandemic. I thought that some of them were heavily discounted, even like the big ones like NAREIT and Simon Property Group. I had invested in both of them, and I still, by the way, hold positions in them. But I invested too early because I did underappreciate the impacts of Capex. The mall landlord had to heavily reinvest in their properties to diversify the uses, to include more entertainment and experiential concept, to not just be fully reliant on retail and fashion. And this was a very expensive process, and it did lead me to think that the cash flow was higher than what it actually was. The dividend coverage was also worse than I thought it was, and these REITs were also a bit more leveraged than they actually seemed to be, again, because a big chunk of the cash flow just went into Capex. So whenever you invest in REITs, don't forget to consider the impact of Capex, because it can be very important and determine whether your invest is going to be successful or a big loss. And then the fifth lesson is that international REIT markets really have a lot to offer and shouldn't be ignored. Most new REIT investors will typically just focus on the American REIT market because it's the biggest, the best developed, and there is a lot of research freely available on these REIT opportunities, whereas it's much more complicated to find good research on international REITs. But speaking from experience, I can tell you that many of my most successful REIT investments of all times have been in international markets, and quite a few times, especially early on when I got started, I would invest in an American REIT that was actually riskier and less rewarding than an international peer, simply because I wasn't aware that this international peer existed, or maybe I knew but I was too lazy trying to find the research on it, or I didn't even want to learn about the dividend withholding taxes. I didn't have the right broker to invest in these shares, or at least not at a reasonable cost. But eventually I made this effort, I learned more about international markets, and I can tell you that it has really paid off, because many of these REITs have been extremely rewarding for me. So these were 5 important things that I wish I knew about the dangers of REITs before I got started. It would have saved me a lot of headaches, some painful losses as well. But yeah, if you think that this video was informative, please click the like button, subscribe to the channel. It will help me a lot to keep on growing. Thank you very much for that. And also, if you want to access my entire real money REIT portfolio, we're offering a 2-week free trial for High Yield Landlord, which is my REIT newsletter. As soon as you join, you'll gain immediate access to my portfolio. And then if the service is not for you, you can cancel anytime in the first 14 days. You won't be charged anything. But if you decide to stick with us for the long run and become serious about REIT investing, you also get a $100 discount as part of the 4th of July sale for your first year. Again, thank you very much for your interest, and see you at my next one. Bye-bye.